So let's look at intangible assets. Now, intangible assets result from capital expenditure being invested into a business which derive a multi-year benefit. The reason why we distinguish intangible assets from fixed assets is that often in the case of an insolvency, intangible assets are often worth much less than the fixed assets of a business. Therefore, we classify assets as either fixed or intangible on the financial statements of a business. Now, when we first bring your historical intangible assets balances into your financial model from your accounting package, these are brought into your historical balance sheet. Your intangible assets are located below your fixed assets within the non-current assets section, and you can see in this example we have one category of intangible assets labelled trademarks. We have the historical balance on the right-hand side of the sheet here, and if we scroll across until the end of our historical time series to our closing month of June 22, we can see that we have a closing balance of trademarks of 2645.7. Now, when we forecast your intangible assets balances, this is located on your asset sheet, and your intangible assets are located below your intangibles capital expenditure. Looking at our analysis, you can see that we have our one category of trademarks coming through, as well as our opening balance of 2645.7. Similar to what we covered in our fixed assets video, our intangible assets brings in our intangibles capital expenditure forecasts into the top of our analysis, where we then handle the allocation of the intangibles capital expenditure items into our fixed asset categories. In the case of our trademarks intangible asset, we have our opening balance of 2645.7 being increased by our capital expenditure forecast at 8.0, being decreased by our book amortization that we've calculated to give us our closing net book value of 2639. Our book amortization writes down the value of our intangible asset over its useful life. We have two main assumptions within our intangible assets analysis. We have our opening net book value term and our capital expenditure term. Our opening net book value term represents the remaining average useful life of our intangible asset and is the period over which we'll amortize this. Similarly, our capital expenditure term assumption is the period of forecast intangibles capital expenditure for which we'll amortize it, or our intangibles capital expenditure's useful life. It's important to note that we assume our intangibles capital expenditure occurs in the middle of the period within our calculations. As a rule of thumb, you would generally expect our opening net book value remaining useful life to be less than your capital expenditure's useful life, as your opening net book value represents the net written down value of your asset. Based on these two assumptions, the average age of our opening trademarks intangible asset is 5 years, as our capital expenditure has a useful life of 20 years and our opening net book value has a remaining life of 15 years. Now, when we calculate our book amortization, this is the same mechanic as we use within our fixed assets analysis. That is, we use a straight line amortization method. There are two components of this 14.7 of book amortization that we're calculating in the forecast month of July 22. The first component being the amortization of our opening net book value over its remaining useful life of 15 years. We calculate this by multiplying our opening net book value by 1 month for the month of July 22 over 180 months, representing our 15 years of remaining useful life. So our first component in our book amortization calculation is our 2645.7 multiplied by 1 on 180. The next component of our amortization is the amortization of our capital expenditure of 8.0 for the month of July. Similarly, we multiply our capital expenditure of 8.0 not by 1 on 240 to represent the 20 years of useful life remaining, but by half on 240 or by 1 on 480, as remember, we assume our capital expenditure occurs in the middle of the period. As this occurs in the middle of the period, we only multiply it by half a month or 0.5 rather than the full month as we do for the opening net book value amortization. These two components, that is our 2645.7 multiplied by 1 on 180 and our 8.0 of capital expenditure multiplied by 0.5 on 240 or 8.0 multiplied by 1 on 480 combined gives us our calculated book amortization of 14.7 for the month of July 22. Our opening net book value plus our capital expenditure less our calculated book amortization gives us our closing net book value of 2639.0 for the month of July 22 for our trademarks intangible asset. When we look at the financial statement impacts of intangible assets within a three-way financial model, our intangible assets hits all three financial statements. Our intangibles capital expenditure is included within the investing section of our cash flow statement, decreasing our change in cash held and decreasing cash at bank. Our calculated book amortization for the month is included on our income statement below EBITDA, decreasing our net profit after tax and therefore decreasing our total equity on the balance sheet. The net movement or increase in our intangible assets increases the intangible assets within the non-current assets section of our balance sheet. The net of our change in cash and intangible assets ensures that our movement in net assets reconciles with our movement in total equity, ensuring that our balance sheet balances. Hopping back to our example, if we want to see our capital expenditure of 8.0 hitting our cash flow statement, our book amortization of 14.7 hitting our income statement, and our closing balance of 2639.0 hitting our balance sheet, we can then head back to our table of contents and activate our financial statements. Firstly, looking at the income statement, if we expand our total depreciation and amortization section, at the bottom where we have our total forecast amortization, looking at our trademarks category, if we scroll across our time series until we get to our first forecast month of July 22, we can then see that we have our 14.7 of amortization on the income statement. And then if we scroll down to our balance sheet, locating our intangible assets in the non-current assets section and expand this, looking at our trademarks, again we can see our closing balance of 2639.0. Finally, if we scroll down to the bottom of the sheet, locating our cash flow statement, if we then expand our intangible assets capital expenditure section within the investing section of the cash flow statement, we can then see we have our 8.0 of capital expenditure hitting our cash flow. Our intangible assets analysis within a 3-way financial model affects other areas of analysis. For example, if we had not paid for our capital expenditure in its entirety, we would then need to adjust for this in our capital payables balance within the current liability section of our balance sheet. If we had GST within our model, we then need to account for the GST owed on top of our capital expenditure. And finally, our amortization has implications on the tax expense from a corporate taxation perspective of the business. Now again, these considerations will all be handled within their own videos. However, for the purpose of this video, when we're looking at the financial statement impacts of intangible assets within a 3-way financial model, our intangible capital expenditure is included within the investing section of our cash flow statement, decreasing change in cash held and decreasing cash at bank. Our book amortization is included within the income statement, decreasing net profit after tax and therefore decreasing total equity. And our increase in our intangible assets value increases our non-current assets section of the balance sheet, ensuring that our change in total assets and therefore change in net assets reconciles with our change in total equity, ensuring that our balance sheet balances.